All good morning. I'm Jagendra Rana. Topic for our discussion today is marine insurance. Marine insurance. The marine insurance is the oldest form of insurance. Oldest form of insurance. And it is said to be the foundation base of all the other type of insurance policies. Marine insurance policies have been used since ages by traders, merchants, ship owners, other contingent interests for protecting their varied maritime interests. So marine insurance protects the insurer against the losses or damages against the marine risk during the marine adventure through multiple modes of transportation. Marine insurance protects the insured against the loss or damages against the marine risk during the marine adventure through multiple modes of transportation. Now, according to Section 2D of the Marine Act 1963, marine adventure includes any adventure where any ship, goods, or other movable referred to as insurable property is exposed to maritime perils. And the earning of acquisition of any freight, passage money, commission, profit, or other pecuniary benefits, or the security for any advances, loans, or disbursement is endangered by the exposure of insurable property to maritime perils. Then any liability to a third party may be incurred by the owner of or other persons interested in or responsible for insurance property by reason of maritime perils. So marine insurance covers the losses or damages caused to ships, terminals, and any transport or cargo by which goods are transferred, acquired, or held between different points of origin and final destination. The term also includes inland marine, but it is mostly used in the context of ocean marine insurance. Marine insurance is a heaven for transporters and shipping corporations because it helps to lower the aspect of financial loss due to cargo loss. So it's a comprehensive cover to protect a loss or damage to goods while being transported from road, rail, air, or sea. It includes separate cover for the loss or damage to the cargo, the ship, freight, and inland transit. Sharing of losses of few among many is the essentiality of the insurance, that is, sharing burden of few unfortunate in the commonality of environment who is exposed to the same risk. So in modern times, marine insurance covers all the risk of the maritime property at an agreed price, meeting the requirement of sales contracts, that is Incoterms, between the overseas traders for LC or banking purpose and become a facilitator of conduction of the modern global trade. So the coverage is made as per the International Institute Cargo Clauses, that is ICCA clause for sea voyages, which has the well-defined terms, conditions, exclusions, period of coverage, loading, unloading coverage, warehouse to warehouse coverage, etc., with add-ons like war and strike, riot, and civil commotions. So marine insurance policies have a very fluid underwriting process, and most policies are often open policies which can be molded as per the needs of the insured. Here are some factors which show marine insurance coverage is really important. The first one is transporting goods across the nation is much safer than before. But accidents do occur. Earlier, transportation of goods used to be difficult as lesser modes of transporters were available. But now, with a constant increase in the transportation business and new sea routes being ascertained, transferring of raw materials and finished goods within and outside the nation has become quite convenient and safe. But the accidents and risks cannot be warded off completely. The incident of piracy of ships have increased in the recent times. Also, nothing is guaranteed whatsoever that there will be no accident of the carrier or theft of the goods. Secondly, worldwide coverage. Certain insurance companies provide global marine insurance for all types of marine risks. These policies aim at protecting the single vessels for complex multinational risks. It is the need for complex multinational. It is the need for need of the hour. It is the need of the hour for the business which have subsidiaries in more than the one nation. So multinational business need a global policy to ensure worldwide coverage for the to and fro of the products. Third one is the marine policy covers each and every type of goods transport. Marine insurance policy is applicable to all kind of goods such as packed or general cargo. The packed cargo includes break, bulk, goods packed in boxes, crates, drums and pallets. Neo bulk, lumber, paper cars and trucks. Unutilized cargo packed in big containers. Then unpacked or bulk cargo. Bulk cargo includes liquid, wet bulk, petroleum, gasoline, LNG, liquefied natural gas, liquefied chemicals, juice and wine in tanker, and dry bulk, coal grain, iron ore, bauxite and cement carried in bulk carrier. Then marine insurance is also available for cargo ships, that is hull insurance. Marine insurance is available for cargo ships, also called as marine hull insurance. The aim of hull insurance is to protect the ships, its machinery and equipment from unforeseen dangers and conditions. This insurance covers all kinds of vessels navigating in all or in any permissible waterway. We use the bigger vessels such as the Massive 18,000, TU Tripoli offer economies of scales, but along with it also increases the risk of loss or damage. So with the bigger boats and vessels being used, insurance for cargo ship is becoming more vital these days. And then insure the goods in transit for single or multiple journeys. Marine insurance policies are available in different structures based on how frequently one needs to transfer the goods. A structure can be selected accordingly. These range from annual turnover policy, a specific voice open policy, and annual policy. And marine insurance covers cost of emergency storage. The need for emergency storage might arise in case there is emergency conditions like extreme weather conditions, riots or some natural disasters such as floods that prevent the cargo to reach its final destination. So the required expenses in such cases are also borne by marine policies if special covers are taken for it. And then coverage for goods discharged at a distress port. Goods discharge is often interrupted due to problems like collapse of a part of a bridge to the port, overturning of the truck that was carrying the goods during night or any such accident. Marine insurance offers cover the risk of such prevented goods discharge at the distress port, which is also known as the inland transit insurance. So some marine insurance providers also cover the risk of loss of profit due to delay in delivery. And then marine insurance can also help the financiers of the goods in transit. The financiers such as banks and financial institutions which may have financed the sad voyage of the cargo in return for interest can also take coverage under the marine insurance. In cases where there is loss or damage due to unexpected mishaps, these financiers have to suffer huge losses for which they can be indemnified under such policies and can be bought and managed online. Nowadays, insurers provide insurance facilitates online services that save your time and prevents paperwork. Online services have also enabled comparison of the insurance policies offered by different insurers and choosing the best one or altering according to one's business requirements. Now the question is how marine insurance policy can be helpful at the time of loss. When one has marine insurance coverage, the following steps should be taken at the time of loss or damage. Taking immediate steps to minimize the losses. Inform the nearest office of the marine insurance company or claim settling agent as mentioned in the policy. In case of damage to goods, as long as they are on ship or port, arrange for joint ship survey or port survey. In case there is a declaration policy, the consignment should be declared within the limit of balance sum that is insured. In case of loss, damage in transportation, a monetary claim should be lodged with the carrier, keeping the time limit in mind to protect the recovery rights. Then damage or shortage certificate must definitely be taken from the carrier. In case any damage is feared in transit, open delivery should be looked forward to. The carrier and their certificate should be obtained and then submit duly assigned insurance policy certificate along with the original invoice and other documents which are required to validate the claim. Examples of such documents are bill of lading, airway bill, guaranteed remittance, packing list, copies of correspondence exchanged with carriers, copy of a notice served to the carriers along with acknowledgement of receipt, shortage damage certificate issued by carriers. And survey fee should be paid to the surveyors appointed by the insurance company at the moment, although this fee will be refunded along with the claim if the claim is admitted by the insurance company. So the additional documents may be required depending upon the nature and type of the loss that has occurred. What all can be covered by marine insurance? Cargo import, export, inland, coastal shipments, ships, hull and machinery with all its fittings, freight, other earnings, charter rent, ships builders risk, ships dismantling risk, onboard store, provisions, voyage, preparation, expenses, etc. Duty insurance, increased value insurance. What is the method of evaluation of the marine insurance cover? The evaluation of the goods is done with subject to the conditions of contract of sale of the goods and accordingly insurance cover is decided. So the marine insurance coverage is proposed keeping in mind the cost, insurance and freight along with a nominal extra 10% taking care of incidental expenses, that is agreed value. Now the question is, what are the types of policies coverage available in Indian market? Marine insurance policies can be altered according to the requirement of the insured, but these are the basic kinds of policies available in the Indian market, like a specific marine policy for short duration of transit, that is import-export, open policy for import-export, and land transit open policy for a special declaration or a special storage risk or annual risk, a specific policy for inland transit, open cover with general terms and conditions of coverage, sailing vessels, duty or increased value insurance, tea or crop insurance, sellers contingency insurance, and insurance of containers. Now, what are the types of marine losses, damages, coverage available in Indian markets? While deciding the policy, one should look for the different kind of coverages available and choose as per the goods. Some goods are more perishable as compared to others. The following are the types of coverage available in Indian markets: partial damage claim, constructive total loss, actual total loss, other liabilities such as both to blame liabilities, collision liability, general average, salvage charges, other expenses like passenger liability, etc. Marine insurance plays a vital role in domestic trade as well as in the international trades. Goods may be totally lost by the operations of the marine hazards. The resulting losses can be immense. Restoring operations can take weeks and even months, which leaves the companies without their cargo and no sale activity. So, in the case of piracy, ships and cargoes are held for months and months on end before any ransom negotiations even start to begin. This levels the businesses massively exposed to the loss if they are not insured properly. So it is imperative that the cargo owners should insure whatever is accurate for their goods, as marine insurance not only protect them from a severe loss but could also protect their businesses from getting its doors closed. Thank you. Thank you very much.